Hello again, everyone. This is the Chapter 13 practice problem video. I'm going to start with exercise 13-1 in the back of the Chapter 13 in your textbook. So that said, Svan AB is a Swedish manufacturer of sailing yachts. The company has assembled the information shown below that pertains to two independent decision-making contexts called Case A and Case B. And we're actually just going to talk in this video about Case A only. So that case said, the company chronically has no idle capacity, and this old model B100 machine is the company's constraint, whatever it does. Management's considering purchasing a model B300 machine to use in addition to the present model B100. The old B100 would continue to be used to capacity as before, with the new model B300 machine being used to expand production. So putting them side by side, basically. This would increase the company's production and sales. The increase in volume will be large enough to require increases in fixed selling expenses and in general administrative overhead, but not in fixed overhead. So what we want to do here is decide for all the items listed A through L, whether for case A, these particular items would be considered relevant or irrelevant to the decision context that we just described in case A there. So basically case A is saying we're going to potentially buy this new B300 to plug in next to the B100, or we're not going to buy it. Okay. Now if you want to review some of the principles of relevance, that's fine. For us, in short, we can think of relevant as just meaning different in some way between decision alternatives. So does this cost or revenue item differ between our choice alternatives? So first up, let's go lowercase a then. This is sales revenue. I might as well just jot them all down and then put our decision next to it here. What does it tell us about whether this is going to be potentially different? We're kind of looking for any indication that this should differ if I buy the B300 or I don't buy it. Well, the whole point of the B300 was to expand production, right? It said that would increase the company's production and sales. So yeah, this sales revenue is relevant to this particular decision, right? If we plug in the new B300, sales are going up. If we don't, they're not. B said direct materials. Now again, the B300 is being plugged in potentially side by side with the B100, ramping up production. We're making more things. So yeah, direct materials are going to naturally increase with that new production. So because of that, we'd say direct materials costs are relevant in this decision of whether we're adding that new machine. Direct labor was letter C, and that's very, very similar to direct materials. Again, we're ramping up production. Presumably we need more laborers to work on the additional units of product. So yeah, that's relevant as well. Letter D was variable overhead. Now, by definition, variable overhead is going to change in total with changes in activity. So if we buy the new B100, we ramp up production, yeah, we're going to have an increase in variable overhead naturally as well. So that's relevant to this decision. E was depreciation, and that's for the old B100. Now that's certainly not changing regardless of whether we buy this new B300 or not. Right? That B100 would be continued to use either way. We're not unplugging it and throwing it away. And depreciation anyway is just an allocation of costs across period, right? In essence, it's a version of a sunk cost. So that thing is irrelevant to this decision. F is the book value of that B100, and for the same reasons as the depreciation, that's also irrelevant. Now G was the disposal value of the B100. Now we'd be tempted to think of this as relevant, right? But in this case, we said that the B100 is being used either way. So we're not going to be selling the B100 if we get the new B300. So that's irrelevant. Now, if this case had described us, trading in the B100 on the B300, or selling it to buy the B300, then it would become relevant. Okay, H was the market value, and this is of the B300. So the cost, in other words, of this new machine. Now, some of these I know sound a little almost like they're trying to trick us in a way, but there is nothing that is intended to be a trick here. If we buy the new B300, we do incur the purchase price of that thing as a cost. If we don't buy it, we don't. So that means it's different between the alternatives, making it relevant to our decision for sure. All right, next up in letter I, we had fixed manufacturing overhead, the general here. And it did tell us in the last sentence of the case setup that this increase in volume, if we buy the new machine, would require increases in fixed selling expenses and in general administrative overhead, but not in fixed overhead. So we're going to say that this is irrelevant. No change there. Letter J was variable selling expenses. And yeah, we're ramping up production if we get the new machine, selling more products, selling expenses should increase. So that makes it relevant. It's different between our alternatives. Almost done here. K was the fixed selling expense. I would just remind us real quick, we just revisited this last sentence a minute ago, but our increase in volume was going to require an increase in fixed selling expenses and in that general administrative overhead. So because it would require an increase, that means it's different. If we buy this thing versus when we don't, that means it's relevant. And then finally, letter L, the general administrative overhead. Just kind of recap this along with fixed selling. It said it would take an increase if we ramped up production. So that makes that cost relevant to this decision as well. Again, relevance for us just is the cost or revenue item, would it differ in one choice versus the other? And in this particular case, the choice was don't buy the B300 versus buy the B300. And that was all that was sort of pertinent to that decision context. Do feel free to work on case B on your own. And again, the solutions for all these are posted on our Canvas site, so you can check your work after you work through that. Okay, I'm going to move on to exercise 13.2, and then we're going to bounce ahead a little bit. So 13.2 had said the Regal Cycle Company manufactures 3 types of bicycles, a dirt bike, a mountain bike, and a racing bike. Data on sales and expenses for the past quarter are shown for each of those product lines and then for the company as a whole. So we've got a somewhat of a contribution format income statement here, sales minus some variable expenses to give us contribution margin. We've got a whole bunch of fixed expenses and then net income at the bottom there. We also note that the allocated common fixed expenses for the company as a whole here are allocated to the individual product lines on the basis of sales dollars. Management's concerned about the continued losses shown by the racing bikes and wants a recommendation as to whether or not the line should be discontinued. The special equipment used to produce racing bikes has no resale value and does not wear out. So the first question or part of this says, what's the financial advantage or disadvantage per quarter of discontinuing the racing bikes? Well, let's think about what happens if we discontinue this thing. The first thing that's going to happen is we're going to have some lost contribution margin headed toward the company's overall contribution margin from sales of the racing bikes there. So that looks like it's $27,000 contribution margin for the racing bikes. Now also we would have some avoidable fixed expenses that would no longer need to be incurred. So I'm going to figure out what these are here. Avoidable fixed expenses. Let's jot them down separate, one by one. So advertising says, yeah, traceable. That's individual advertising for the individual product lines. So that would certainly be avoided. Depreciation of special equipment. Now that is traceable to the racing bikes, but it's not avoidable. It told us that the special equipment has no resale value, it doesn't wear out, so this is just cost being allocated across periods for that equipment. It's nothing that's going to change in the future regardless of what we do here. That's kind of a sunk cost or associated with that sunk cost. Salaries of product line managers, yeah, that would certainly be avoidable. So I'll just say salaries here, and that's $10,000. If we don't sell racing bikes, then we're not going to have a racing bike product line manager, right? That person's going to be looking for another job. And then this last one, again, we'll just be careful. Allocated common fixed expenses. These are common fixed expenses for the company as a whole. And right now they're being allocated to the individual product lines based on their relative sales dollars. So nothing implies that any portion of that would go away or decrease if racing bikes are no longer made. So because of that, none of that is avoidable in this scenario. So let's figure out what that net advantage or disadvantage is here then. Just 3 items to consider. And in essence, we're saying, well, we've lost contribution margin of $27,000, right? But we've recouped or would recoup advertising that's avoidable of $6,000 and salaries of $10,000. So this difference of $11,000, in fact, if you want to think about that in terms of a sign, really that's the disadvantage or a negative, a decrease to overall potential profitability. So this is the net disadvantage of discontinuing the racing bikes, $11,000. So if someone asked us, should the production and sale of racing bikes be discontinued, as we're asked in part 2 there, the answer is all things equal, no, they should not be discontinued. It would make the company worse off as a whole. Now, the third part said, prepare a properly formatted segmented income statement that would be more useful to management in assessing the long-run profitability of the various product lines. Okay. If we think back to chapter 6, when we first introduced this idea of segmented income statements, those things followed our contribution format income statement, and then they also had that new subtotal for segment margin. So let's think about how that would look here for the racing bikes. So we'll do line by line. We'd have sales. I'm just going to abbreviate some of these here. Variable expenses in total. Where's our contribution margin? Now, if we're thinking about a segmented income statement, we'd want to next show the traceable fixed expenses, and that would be advertising. Depreciation is traceable, but not avoidable. Then we'd have salaries of the product line managers. That would be it for traceable fixed. That would leave us with segment margin. Then we'd show those common fixed expenses, and that would get us to net operating income on the bottom line there. Okay. So let's jot down some numbers here. I'm actually going to kind of go through and sketch out all the product lines here. But let's start with the racing bikes. Okay, they had sales of the 60,000, variable expenses of 33, so contribution margin of 27. Now again, their advertising traceable, 6,000. Depreciation of that special equipment, 8,000. The salaries, 10,000. Well, let's see what that leaves us with a segment margin. We'll use the numbers to be explicit here. Contribution margin of 27,000 minus all the traceable fixed. So advertising of 6, depreciation of 8, and then salaries of 10. Leaves a segment margin of $3,000. Now in a segmented income statement, that's where the income statement ends for the individual division or product line or what have you, okay, right at that segment margin total. And our decision point is if this segment margin, in fact, I'm going to kind of write this, if segment margin is at least 0, then we're going to keep that product line. We're going to assume it contributes something to the bottom line of the company as a whole, or at least doesn't take anything away from it. If segment margin were to be less than 0, we'd want to potentially consider discontinuing that segment. All right, let's fill in a few things for the other ones though, just to see how this flows to the company's kind of total column there. So dirt bikes had a contribution margin of 63,000. advertising of 10, depreciation of 6, salaries of 12. So the segment margin, CM, minus those traceable fixed only, or a segment margin of 35,000. Mountain bikes had CM of 90, advertising of 14, depreciation of 9, salaries of 13. Oops. So a nice segment margin there of CM minus those 3 traceable fixed expenses. Segment margin 54,000. I'm just going to pull the totals over here. Total segment margin then for the company as a whole, the dirt bike segment margin plus the mountain bike segment margin plus the racing bike segment margin, for a total of 92,000. Then they've got those common fixed expenses at 60,000. So total net income for the company, that same 32,000 that we showed earlier. Okay, so just kind of rearranging some things to give potentially a hopefully more useful view of profitability of the individual segments. Again, for our purposes, if segment margin is at least 0, we're going to assume we want to keep that thing. All right, next up on my list was 13-5, a volume trade-off decision problem. This is one of those areas where, cost accountants out in the wild sort of make their bread and butter. So 13.5 said Outdoor Luggage Inc. makes high-end hard-sided luggage for sports equipment. We've got data concerning 3 of the company's most popular models shown for us: the ski guard, the golf guard, the fishing guard. We know selling price, variable cost per unit. We also know how much time each unit of product takes on this special molding machine, as well as how much plastic's needed to make a unit of each product. Now, first up, it said if we assume the total time available on that plastic injection molding machine is the constraint in the production process, so what really binds how much we can produce, how much contribution margin per minute of the constrained resource is earned by each product? Well, let's figure that out. Here's the ski, the golf, and the fishing guard. We know the selling price per unit. We know the variable cost per unit. So let's first come up with the CM per unit of product and then worry about these constraints. So ski guard sells for 200, has variable cost of 60. So that CM per unit is 140. And just to be explicit here, that's 200 minus 60. The golf guard sells for 300, variable cost of 140. So every unit we sell of the golf guard contributes $160 to the bottom line. And then that fishing guard sells for $255 with variable costs of $55. So each unit we sell of that contributes $200 to the bottom line. Now, first up, we were trying to determine what's the CM per minute on that plastic injection molding machine. The ski guard has a CM per unit, so that's per guard, of $140. And it takes 2 minutes on that machine to make one. So every minute I spend making the ski guard, I generate $70 in CM, assuming I sell everything I make. For the golf guard, it's $160 per guard, but that thing takes 5 minutes, so it generates $32 per minute. And then fishing, $200 per unit, divided by 4 minutes to make a unit, and there's $50 per minute. So part 2 said, well, which product offers the most profitable use of that machine if it's the constraint? Well, there's our ski guard right there, right? Every minute I spend making those things can generate CM of up to $70, more than if I'm making the fishing or the golf guards. Now, part 3 says that if we assume there's a severe shortage of plastic pellets, is required the company to cut back its production so much that its new constraints become the total available pounds of plastic pellets, how much CM per pound of that new constrained resource is earned by each product. So now we're saying CM per pound of plastic. Well, the ski guard was $140 CM per guard per unit, and it takes 7 pounds of plastic. So there's $20 per pound. The Golf Guard had a CM per unit of 160. It takes just 4 pounds. So it generates twice as much as that, $40 per pound of plastic. And then fishing was $200 per unit, but it takes 8 pounds to make one. So there's $25 per pound of plastic. Now the natural follow-up was which product offers the most profitable use of the plastic pellets. This time it's the Golf Guard. Okay, so if our constraint were to be the raw materials, the plastic, we'd want to focus on making as many of those as we could. Okay, the last piece said which product has the largest CM per unit. Why wouldn't that be the most profitable use of the constrained resource in either case? Yeah, what they're pushing us to here is what we came up with first. The CM per unit was the Golf Guard. That was the winner. Or excuse me, the fishing, the $200 per unit. Meaning every unit of the fishing guard I sell, I generate $200 to the bottom line. But that thing was resource intensive, or at least relative to one of the other products. It took more time on the injection molding machine than the ski guard. So it was a less profitable use of that if that was the constrained resource. And it used more plastic than anything. So it was not the best use of plastic if plastic was the constrained resource. Okay, so always important for us to consider our constraints in our production processes. It's sort of the punchline here. All right, next up I had 13.7 in mind. We need to think about these decisions of selling or processing things further. So Dorsey Company manufactures 3 products from some common input. Joint processing costs up to the split off total $350,000 per quarter. And right off the bat, I'll point out that's a sunk cost, right? Joint processing costs up to the split off are irrelevant every time in these decisions to sell or process further. For financial reporting purposes, the company allocates those costs to the joint products on the basis of relative sales value. Fine, don't care. Unit selling prices and total output at split off are shown first. So we've got products A, B, and C. We know what they sell for in this quarterly output. Each of those, though, can be processed further after the split off. Additional processing takes no special facilities. The additional processing cost per quarter and the unit selling prices after further processing are what's shown second there. Okay, so sell it split off, that's our first box. Second box is the additional processing costs and what we can sell it for if we do that processing. So the first requirement said, what's the financial advantage or disadvantage of further processing each of the 3 products beyond the split off point? And then second, which should be sold at split off and which should be processed further? They'll go hand in hand. So this is A, B, and C. Now for us, the decision point becomes, is the incremental revenue associated with doing some additional processing greater than the incremental cost of doing that processing? Okay. So for product A, what we're saying is that incremental revenue is the $20 per pound selling price if we do the additional processing, minus the $16 selling price per pound if we don't, times the total output of the product. So $20 minus $16 times the 15,000 pounds we can make of product A every quarter. So incremental revenue is $60,000. Incremental cost of doing the extra processing, though, it shows us, is $63,000. So the net is the difference between those. Right? And I'll keep signs for this one. So revenue 60,000 minus cost of 63,000. We've got a net of negative 3,000. That's the financial disadvantage of doing the further processing. B had a selling price after additional processing of $13 per pound versus a selling price at split off of $8 per pound times the 20,000 pounds we have of this stuff or can produce of this stuff means potential incremental revenue of doing additional processing of $100,000. Now the incremental cost of doing that processing is $80,000. So in this case, 100 minus 80 means a net advantage of $20,000 to do that additional processing. And then finally, letter C. This thing can sell for $32 per gallon if we do some extra processing versus $25 per gallon if we don't. And we can produce 4,000 gallons of that stuff every quarter. So the potential incremental revenue, $28,000. Incremental cost of doing that processing though is $36,000. So we see where this one's headed, 28 minus 36, and there's a net disadvantage of $8,000. So which should be sold and split off, which should be processed further? The only one that should be processed further here is product B. That's the only one where the incremental revenue of doing all that extra work exceeds the incremental costs of doing the work. It's the only one that makes financial sense for us. Okay, just a couple more to work through here. The next one on my list was 13-9. This is a special order decision. Now, Delta Company produces a single product. The cost of producing a single unit of this product at the company's normal activity level of 60,000 units per year, shown in the box here. Direct materials, direct labor, variable overhead, fixed overhead, variable selling and admin, and fixed selling and admin. We also know the normal selling price is $21 a unit. The company's capacity is 75,000 units a year. An order has been received from a mail order house for 15,000 units at a special price of $14. This order would not affect regular sales or the company's total fixed cost. What's the financial advantage or disadvantage of accepting the special order? All right. If we accept this special order, we're going to have a bunch of incremental revenue. Now, it's at a reduced price relative to our normal sales, but we're proposing that we would collect $14 a unit from this mail order house times the 15,000 units they want to buy. Okay, there's our special order, 15,000 units at 14 bucks. So incremental revenue, 210,000. Now let's figure out what the incremental costs are. I'll go ahead and list these one by one, make sure we're clear on each one. Direct materials would certainly be incurred to produce, the extra 15,000 units, right? Direct materials is truly a variable cost. It moves with activity or volume. So $5.10 a unit times the 15,000 units we'd be making, 76,500. Direct labor is up next. Very similar. It's purely variable cost. Moves with volume, so $3.80 per unit times the 15,000 units we'd make, 57,000 total. Variable overhead, similar deal. That's $1 a unit. And again, this order is for 15,000 units. So there's $15,000. Now, fixed overhead is next. Just be careful with some of these fixed expenses. It tells us that this order would not affect regular sales or the company's total fixed costs. So we're not going to have to expand production or capacity in any way, right? They told us that their normal activity level was 60,000. Right now they've got capacity of 15,000 extra. So we're not needing to make any changes to operations. So no change to total fixed costs. So because of that, we don't need to consider this fixed overhead cost, right? It's not an incremental cost of filling this special order. Fixed overhead is going to be the same in total, no matter what our production level is. Variable selling and admin, well, by definition, that's going to change in proportion to changes in activity. So we do need to consider that. $1.50 per unit, again, times the 15,000 total units in this order. So there we go, 22,500. And then finally, fixed selling and admin. Well, that's similar to our fixed overhead. There's no change in total fixed cost. So all we'd be doing is spreading the total fixed cost over more and more units. So nothing for us to consider there. So let's figure out what that net would be. we had incremental revenue of $210,000 potentially, minus the incremental costs of direct materials, direct labor, variable overhead, and then just that variable selling and admin. So our net potential advantage or disadvantage, well, that's an advantage of $39,000. So all else equal, we would accept this special order. Okay, now part 2 said, as a separate matter from the special order, assume the company's inventory includes 1,000 units of this product that were produced last year and are inferior to the current model. The units must be sold through regular channels at reduced prices. The company does not expect the selling of these inferior units to have any effect on the sales of its current model. What unit cost is relevant for establishing a minimum selling price for the inferior units? Well, let's think about what it costs to produce these things and which costs are potentially relevant here. So it did cost us to make these 1,000 units, some direct materials, some direct labor, some variable overhead, right? But those have been incurred last year when we made these inferior model products, right? So they're a good example of a sunk cost. So we don't need to consider that. Fixed overhead and fixed selling and admin, again, by definition, our fixed costs aren't changing in total no matter what happens. Plus, those had been incurred to support production last period, so those aren't relevant either. So really, the only thing that is relevant is this variable selling and admin expense. It does tell us we'd have to sell these things through regular channels, but just have to cut the price. So $1.50 in selling and admin expenses, whether that's commission or shipping or whatever else, would be incurred here. So the unit cost that's relevant is really just the $1.50 in variable selling and admin expenses. Might sound a little funny to talk about things that way, but truly these units of product are old and junky, right? We're either going to throw them away essentially or sell them at a cut rate. So the only thing that becomes relevant then is what does it cost us to move them? And in this case, it's the $1.50 in variable selling and admin expenses. Okay, last up on my list was 13-11, just a bit down the E page here, for a make or buy decision. So 1311 said Han Products manufactures 30,000 units of this part S6 each year for use on its product line. At this level of activity, the cost per unit for part S6 is shown with direct materials, direct labor, variable overhead, and fixed overhead for a total cost of $25. An outside supplier is offered to sell 30,000 units of this S6 each year to Han for $21 a part. If Han accepts that offer, the facility is now being used to make the S6, could be rented to another company at an annual rental of $80,000. However, Han has determined that 2/3 of the fixed overhead being applied to S6 would continue even if S6 were purchased from the outside supplier. So this fixed overhead represents facility-wide charges that are supporting kind of everything we do. A whole bunch of that would continue then, even if this S6 were purchased from the outside supplier. So what is the financial advantage or disadvantage of accepting the outside supplier's offer? So let's start to tabulate some costs here relative to make and buy. Okay. Well, let's start with the buy, because that's kind of the quickest one, right? We've got the purchase price of $21 per unit, and we need 30,000 of these things every year. So if we're buying from the supplier, we're paying $630,000. Now, we wouldn't incur any direct materials costs, we wouldn't incur any direct labor or any variable overhead, but we would incur some of this fixed overhead, right? It said 2/3 of that would continue even if the S6 were purchased from the outside supplier. So the first thing we're going to do, in fact, I'm going to jot this up here, is figure out what that total fixed overhead is per year, right? It told us that every time we make 30,000 units, this normal level of production, that fixed overhead is $9 on average per unit. So that means the total fixed overhead is 30,000 units times that $9, or 270,000. So if we buy from the outside supplier, we're still going to incur Let's see if I can do this and leave myself enough room. Some of that fixed overhead, right? 2/3 of it, in fact, times the $270,000, okay, or $180,000. Now that's it if we buy from the outside supplier. Okay? Let's figure out what some of these costs of making are. We'd still have direct materials, or we would have direct materials. We'd certainly incur direct labor. We'd incur some variable overhead, and then we'll see if we're missing any in just a minute. Direct materials was $3.60 a unit. And again, we're talking about making 30,000 units every year. So total of 108,000. Direct labor is an average of 10 per unit. So times 30,000 means a total of 300,000. Variable overhead is $2.40 a unit times 30,000 for a total of $72,000. And then fixed overhead we just determined would be the full $270 if we're making. Now the other thing for us to consider is right in the middle of this paragraph. It said if Han Products accepts the offer to buy from the outside supplier, the facilities now being used to make this S6 could be rented out to some other company at an annual rental of $80,000. So what we have here is a classic opportunity cost of continuing to make this product in-house. Right? So it's not costing us an outlay of cash, but it is costing us an opportunity to make this part in-house and not rent out this space to the other company for 80 grand. So we really should consider as a cost of continuing to make this thing that opportunity cost lost, $80,000. Now you could show it as a reduction on the buy side. That'd be, you get the same answer either way, but really an opportunity cost should be shown as a cost to where that opportunity is given up or sacrificed. So let's see what the total cost is here in both cases. I'm just going to sum the columns. So we got some different items here. So total cost of making this thing in-house, 830 grand. Total cost of buying from the outside supplier, 810,000. So all else equal, the net advantage of accepting the outside supplier's offer is the difference between those two, or $20,000. And it's worth noting here that really the decision changes if this opportunity cost isn't there. Right? If we don't have that potential opportunity to rent out the factory for 80,000 bucks, then it's cheaper for us to make it in-house. So very important economic decision here. Okay, and with that, that wraps up exercise 1311 and wraps up the chapter 13 practice problems. Feel free to back up and revisit any you need to, and let me know if you have any questions.